Okay, so welcome everyone to the FP Markets tutorial on a rule-based trading, or building a rule-based system that you can work with. So my little quote here, I was having a think about this today. Dr. Zeus, think left, think right, think low, think high, and the things you can think up if you only try. And that really sums up what this 3 series is about. It does require some effort on your behalf, and you have the commitment of Ivan and I on anything that comes back our way, anything that is offered back. So we'll get ourselves going. This is information, material is for general advice only, does not take into account your investment objectives, financial situation or particular needs. We recommend you consult a licensed advisor before acting on any information you may see or hear. A little bit of my background for those that didn't catch up with this on the Saturday. I was in Melbourne. I hold a diploma in technical analysis through FINSA with the accreditation of IFTA, and I spent several years on the desk broking, mostly in options, equities and options, with Macquarie, RBS Morgans and Wilson, and hold ATAA 1 and 2 derivatives accreditation. I'm currently the President of Sydney ATAA and a member of the Professional Analysts Association as well. Ivan is with us. Ivan is really a founding member of the ATAA. He wrote the work that I studied for a number of years to obtain the diploma work, was the work of Ivan and a few others at the very formation of the ATAA, and it was since then accepted on a global basis through IFTA. So a little bit of background there. He's a contributor to he started the ATAA newsletter in its day. He's a trader, educator, mentor and author of Listen to the Market. Been involved with the market since the early 80s, both here in Australia and overseas, and having traded shares, options, futures and FX in the highly regarded US stock market option commodity trading championship in '84. Ivan's performance was acclaimed by the Australian Financial Review as a record for an overseas competitor. So Ivan,
that's all ancient history, Gary. Let's move on.
That's what? Sorry, move on. Okay.
Ancient history.
Yeah. Okay. So what we're going to look at tonight is essentially I'm going to very briefly go over what we went through in Melbourne, just to bring you up to speed again on that, and talk about the basis of the concept behind putting a rule-based system together, and the intention of tonight's one is to give you some ground rules or some groundwork to work with so that you can come back in a week's time with something that you own, and something you've done a bit of work on, and something you own, and there's something that may work for you. So in Melbourne, I talked about this scenario here, that if a potential trade is identified, and the things that we only know at this point are the distance, or the distance to stop. We know our entry price, and that's really the basis of what we know our distance to initial stop on there. And whatever happens, whatever occurs after this is really not our doing. It's now a function of the market, and we want to build a series of guidelines or a series of rules around, I'll use the word rules around dealing with that information as it comes to us in that time frame that we're working in. So what we do know at this point is the percentage of the account we're going to risk, or the R value, the risk value, the position size, which equates into our position size, and the entry price, and the distance to our initial stop loss, where that may be. And after that, as Ivan often laments, the outcome is unknown. So I made the point that whatever happens after this is really a function of your campaign management, the way you manage that position, and the rules around managing that, or implementing your rules to manage that position along the way. And it's really not up to you what occurs after here, because the market's going to present you with information as a course of its function. So Then we have
Gary,
yes.
Gary, the point there is, in Ivan's speak, I don't trade a market. I have a campaign in a market, which means a very structured approach to various possible outcomes.
Yes.
Anyone that has a halfway decent brain can press the button like a monkey, buy now, sell now. But a campaign is far more involved than just a buy or a sell routine. Over.
Okay. So we then asked what the game was. What's the chess game here? What are we actually doing here when we face up to the market? So we have choices about what we can where we can take our information from, and I presented this on the Saturday in Melbourne, and I notice I've added in down there myself and Ivan as well, is who do we believe in here. Our first choice is a research of the news or the CNBC or the tip sheet or something like that, and often we're caught here in the middle between good news and bad news, and it can be quite disabling, particularly when you look at the events of the last week and a half in the UK and Australia. The second choice is we can take on our own rule-based trading system or our own rule-based trading called an RBT, which is what we're going to go through in this session. So like many games, it's about working out the odds and working with those odds to build a rule-based approach. And Ivan, you mentioned to me about the odds of someone buying someone had actually beaten the odds in buying a lottery ticket.
I did.
That they'd actually then were disallowed the win because they'd beaten the market essentially. But we want to build a rule-based system to approach the market that we're working with based on some statistics that we gather out of that market, and look to go forward with those statistics and build a rule-based approach. So the game is understanding the risk and reward ratio. So the things that the reward part of our market is the target, providing our initial stop loss is not hit first, and the reward is then dictated by will that instrument still be alive, and that refers to will that futures contract still be in existence, has it not met its expiry date, or is that options position still in existence because it has not met its expiry date. That type of information will dictate our reward, and you're exiting at a target or exiting at a predetermined point. So reality is that our risk, the reality is the risk is up against our risk ratio of how many times that something might actually pay off as a risk ratio. Do you want to add something there, Ivan?
I do. The traditional approach is always to say, I want to risk X, Y, Z to make ABC. Well, there are so many unsaid assumptions behind the making ABC, as you illustrated, Gary, above, that the ISL is not hit first, the instrument is still alive, and you actually have the gumption to sell into a rising market. Most people don't have the emotional discipline to stick to their rules. Most people don't have an RBT to start with. Over.
Okay, so we went through this little exercise as in Melbourne here about a series of events that are occurring, and I pointed out that whatever's we have two markets here, and whatever's happening in market 1 or market 2, in market 1 it is producing a series of zeros, and whatever's happening in market 2 only produces X's. So there's pretty much guaranteed on the right hand side that you will produce another 0 and another X because you don't have any evidence of anything else. Then the next one we moved on to was this, where we produce a 0 and an X and a 0 and an X and so on, and it's quite repetitive, and it can only produce a X and a 0 here at the right hand side, and on the bottom can only produce a 0 and an X here on whatever's happening in that process in market 1 and 2. And then it got a little more involved where we have a 0XX and a 0XX. So there's still a pattern, still a process, still something going on that produces this on a repetitive basis. There is really no market in this. So here we have 0XX, X triple 0, X triple 0, X triple 0. So it would be fair to say on the right hand side we would produce a triple 0 here at the bottom. And then
or at least 1 0.
Or at least 1 0, yes. So then we came to this little example here where we're producing a seemingly random 0XX on our top line, 0XX, 0x, 0x, 0x and 3x's and 0 and 4x's and so on. And then at the bottom we have our X and a series of zeros through there. So something is now not producing a strictly repetitive pattern, but it is producing groups of something. It's producing a group of zeros. And what, rather than this look random, and it was quite interesting, I had a lot of feedback from a chap in Melbourne he struggled with the maths around this and sent me some very interesting links on random number generators. But in this, we take it as it is. In this bottom line, for example, we have a series of zeros and an X and 2 zeros and an X and 3 zeros and so on. So what we really want to look at is the patterns that show up here, that there is something going on here that can produce a series of zeros and an X and a series of zeros and 2 X's and 2 zeros and an X and a series of zeros and 2 X's. So on the right hand
Gary,
yes.
With that screen on the bottom line, you got X with 4 zeros.
Yes.
Followed by X with 4 zeros.
Yes.
An X with 2 zeros, an X with 4 zeros.
Yep.
So from a probability-based approach, what's the probability of another 0 after 3 zeros? On screen, 100%.
Yep.
And that's what trading is really all about.
Yep.
By looking at the probabilities of, if this happens, then on all probabilities, something next will happen.
Yes. So at the,
yes.
So at the right-hand side, we can produce 1 0, or we can produce 2 zeros or 4 zeros before we get an X.
Well, from my side, up to 3 zeros, I want to punt on the 4th 0.
Yep.
And that's what pattern recognition is all about.
Okay, so
over.
When we apply this to just an observation of some price action, then we can say, well, there's a pattern of 4 zeros here, which may represent 4 higher highs in our market, and then a lower high or an inside day or an outside period, and then a series of higher highs again. So these patterns show up, and it's not indicative as to, on our right hand side here, which one is going to show up next. But we can build some studies around this and build it into a rule-based system. So the game is understanding the simple probability of a movement in the market, whether it's any market, whether it's the equities market or the futures market or the FX market. It's a movement in the market. And we say that often traders try and outthink the market and then make broad statements like it's going to go up. You can see my little man down there with his thinking cap on as we try and outthink the market. So the game is understanding the simple probability of a movement, of an event, a movement in the market. So it's going to go up is saying I know what's going to happen in the next 60 minutes or the next day. And you will have noticed that even in my Monday morning webinars and some of the other work that I do, we make these assumptions about where things are going to go, and that's what this is. It's saying it's going, that we make this assumption about forward movements in the market. Really, the true effect, as we talked about in Melbourne, is, well, no one actually knows what's going to happen next, but it is building a system around that that allows us to deal with
talk about it.
Yes. Okay. So
no one knows what date or month they're going to die on. Yet everyone, when they want to trade, they want to know, will it go up or will it go down?
Yeah.
And that's a pure folly from my side.
Yep.
Being 2,000 kilometers away in that.
Okay.
Over.
Okay. So now, a very quick word about money management here, and this is just one idea. This is going to tie in as we go in the next 2 weeks. It'll tie in with some of the work that we're going to ask you to do. Is in the when you look at percentage of decision to risk, if, for example, we have an account size of $100,000 and the decision to risk is 1% of that account on a campaign, on a position in the market, then that equals, of course, $1,000. We then come back and nominate our distance to stop loss in dollars and cents, and the distance, the example I'm using is 32 cents, and so we divide the amount that we're going to risk by 32 cents to give us our position size. Quite a textbook methodology of position size. So in this example where we're using 1% of our account, we're using $1,000 divided by 32 cents gives us a position size of 3,125 shares. If this position goes to our initial stop loss, our exit point, then the total risk is known at 1% of our account.
Being $1,000.
Being $1,000. Then there's an example here, again risking 1% of $100,000, but we're using a SPY futures contract. Again, if we decide to risk $1,000 and 1%, I beg your pardon, which is $1,000, we again nominate the distance between entry and our initial stop loss in points, and the distance to initial stop loss in this case, I'm using 10 points. So the SPY contract trades at $25 per point, therefore 10 points is $250, and we divide our initial risk, our 1%, our $1,000 by $250 gives us a position size of 4 contracts to take. If our initial stop loss is hit, we know that our risk then is the 1% of our account. So building a rule-based trading plan, or an RBT, I'm going to use the acronyms going forward from here. We really then want to come back to the market in relation to our RBT, to look at the market and build these statistics out of what we're looking at in the market, and it's quite simple to do to build our own rule-based trading plan. One of the examples that I incessantly talk about on the Monday morning program and in all of the workshops I do is based around pivot points. So going forward, the group that we've got here going forward, what we would like you to do is put your thinking caps on and come up with, the idea here is to come up with an idea, and I'm going to show you a couple of ideas you can run with if you like, or you can certainly come up with your own and go forward with that, but we're going to ask you to prove it, to prove some statistics around your idea. So in this idea here, a pivot point. Pivot points are interesting. In Ivan's book, he describes a pivot point being at every turning point in the market, and it certainly is. So a pivot point is described on this left-hand diagram here as where the market has moved down. In this case, a bar makes the low down here. You don't know which bar is going to be the low. So our bar down here has a lower high, lower low, and the following bar after that in this example has a higher low and a closing price above the high of the bar that makes the low. This concludes the pivot point. The actual pivot point is now in place. So the observation here is that there will be a bar that makes the low, and which has a high in that bar, and the second observation is that the close of the following price action must close over that high to form the pivot. In the rising market, where the market makes a high, over here on the left we have a bar that makes the high, and that bar has a higher low and a higher high, and then the following bar after that produces a lower high and a closing price below the low of the bar that makes the high. The pivot, this forms the pivot, the reverse pivot on the high side of the market. So there,
Gary?
Yes.
By definition, a low will always be formed by a pivot. It will always have a bar that has a lower low than the bar before, and sometime in the future there will be a bar that closes above the high of the bar that forms a lower low and lower high.
Yes.
Which means by definition every turn will be and can be defined by a pivot point turning point.
Yes.
Which is really great when you're looking to work with definitions of trend.
Mm-hmm.
A trend up will be a series of higher pivot point highs. A trend down will be a series of lower pivot point highs, which makes it a really black and white way to deal with markets in their evolution between being in trending staircase to heaven mode or staircase to hell mode.
Yes.
As you're discovering with your own journey.
Yes.
Over.
Thank you. Okay, so a pivot point is defined by the closing price over the bar high of the bar that makes the low in a higher close, and a pivot point here on the right hand side is the close below the bar, below the low of the bar that makes the high. Now I'll go into this a little bit more in just a moment, but essentially that's what puts a pivot point in place. With this observation, with a simple observation like this, you can sit down with a chart and mark off the pivot points, and I'll show you an example in a moment. Mark off the pivot points and build a trading system or rule-based system around this by defining your entry, defining how long you'll be in the market, bar by bar, and where your stop loss, initial stop loss will be on the entry. So
and Gary?
Yes.
Gary, MC Trader 4 will not do that for you, nor will IC Markets or Spot Trader, nor will Metastock.
Yep.
One has to pull one's finger out and actually do it manually.
Yep.
Most of the time to come up with the results.
Yes. Yes, that's what I'm. Yes, that's right. I can attest to that. As I said earlier in this presentation, I did the diploma work over 10 years ago. The diploma work that Ivan has written, and since then, in the last couple of years, Ivan and I have done. Ivan's opened my eyes to a very different view of the market since then. So, and this is what we're going to share with you in these next 3 weeks. A variation of the pivot point example, I'll go back one slide. This is a nice textbook example, of course, just to understand what's required. And then you get variations of that. Not everything is textbook, as you know, in the market. In here we have the market moving down.
Gary, it depends on the textbook.
Yes.
Over.
In here we have the market moving down, until the lower high, lower low, and then the following period we have the first requirement, which is a higher low, but we don't have the close above the high of the bar that makes the low. In the second period after that, we have the higher low again, and it trades out past the high but closes back inside the high, and the third bar here closes outside the high of the bar that makes the low. This concludes the pivot is in place as a variation of a simple pivot point. And then, of course, when you start to look inside, and this is really what I'm going to encourage you this week, is to start looking inside your charts bar by bar as you go along, and do a little bit of work for yourself. Is that in this example here we can quite clearly see that the market has moved up into a high right here. I'll just get my little pen out. The market has moved into a high area here with a higher high on this bar. The following bar closed below the low, so the pivot point is now in place as a true pivot. So the pivot is now in place, and the following price action we saw a bar follow through with a lower high, lower low. Then we had this inside bar here, and I'll just put a little mark on that here. This has the first ingredient of setting a pivot point the other way, where we have the higher low here from the bar that makes the low. So the bar that makes the low here has a higher low on the left hand side, has a higher low on the right hand side, so they're very potential for a pivot to come in here. And we saw in the following price action the following 1, 2, 3, 4 bars failed to close above the high of this bar, so the pivot wasn't formed and the market got on with where the market was going. So it's the intention of this observation here is to ask you to look at each individual bar when you put together a thought about what you would like to work with in the market. Look at each individual bar in its own context and start to observe how they actually relate to each other based on your observation of the market. So pivot points are one area to work with. Some of the other work that we've done with Ivan in the past tutorials is, and Ivan's produced some stunning statistics on this, is what we call the promise bar. And I'll go here down on the left here. The promise up bar has a larger range than the previous bar. So it's not to do with the body, it's to do with the range. So the statement is that the promise up bar has a larger range than the previous bar. So in this example here we can see that this bar here has a larger range than the previous bar in here. And the promise bar has a higher low and a higher high. So it has the higher low and the higher high. In the other example here, the promise bar here has a higher low and a higher high. So and a larger range than the previous bar. So it simply becomes what's called a promise bar. And on the downside of the market, the promise down bar has a larger range than the previous bar, and the promise bar has a lower high and a lower low. So we can see here the lower high and the lower low, and it is a larger range than the previous bar. And the other example I have here again is the bar here. The following bar has a lower high and a lower low and is a larger range than the previous bar. So it's just simply observed as a promise down bar. I just want to go back, let me go back into this. When we look at when we start to break down some charts, and we'll go to a couple of charts in a moment, but when we start to break down our charts now, what we want to look at is this type of observing this type of price action in the market, this type of price movement bar by bar in the market. Does it fit this criteria? Does it fit the pivot point criteria? Or is it an inside period or an outside period? Those types of observations. So based on the where we've come so far, the homework this week, the quest this week, is for each participant to print out 4 consecutive sheets of 50 bars per sheet. And I've got just an example here that each one of these sheets here, it's the same stock, just 50 bars. I've just moved the chart along, printed 50 bars, moved the chart along, printed 50 bars, and so on. And
Thank you, Gary.
Yeah, I don't know what happened there. I'm just sorry, Ivan got himself muted.
Okay.
Technology, you got to love it. Okay.
Better than muted.
Yes. Okay, so the homework, the quest this week, what we would like you to do, what we would really like you to do, is to print out 4 sheets of 50 bars. It's not a hard task to do. It's quite an easy task to do, and start to mark out an observation of the market and how you would treat that observation of the market if it turned up again in future price movement. So in this example here, it is the same stock. I've just adjusted everything so that it seems to flow a little bit, but it's simply 50 bars on each page. And and what we want to do here is we want to build a series of rules around an observation. So a simple observation. This is something. This is the beginnings of something that I would encourage you to. The road to go down here is looking at it looking at it this way. So we've got here. This is I think it's a 3-hour gold chart. On this particular chart, I've got 103 bars, just that I wanted to get a bit more information on as an example. But what I'm building here is an idea that, and I've marked off all of the pivot points, pivot point down and the pivot points here on the bottom of the pivot points up, all the way along, every single one of them on here. And we often find there are examples on here where there was an example here, down here, and I'll get my pen out again, there we go. There was an example here where the pivot point simply wasn't fulfilled for many bars all the way through until here. So there's I think there's about 12 or 15 bars in there where the pivot point was never really fulfilled, and the next one wasn't fulfilled as well. So that allows you then to say, well, okay, well, around that, what can I build around that? So all I've marked off now is I've marked a little horizontal line is when the closing price, when a bar actually closes out and forms the pivot. So there's a number of them on here, and starting to work with this and work with this as working within 3 bars. So I've said that the pivot point must form within 3 bars. Otherwise we just ignore it, because at times like this down here where it's simply just one market just wanders along and doesn't fulfill the pivot. So the example is in this little rule-based idea, in this observation of 103 bars, there were 20 upward 20 pivot points along the base and 18 pivot points down along the top. And it's a work in progress, so I haven't got any numbers yet. So next week I'll have my numbers out on whether this little methodology works on a 3-hour gold chart. So my first statement I made to myself was, we'll close out the trade on the first bar of profit, or we'll close out after $1. of profit. So I'll go through and work the numbers on this and see whether this is a viable outcome to build some form of rule-based trading around. So that's my quest for the week. Ivan, do you want to add anything in there?
I do, Gary.
Yep.
Thank you for the offer. Where do I buy?
What's that? I missed that.
Where do I buy? Where do I sell? Give me the shortcut.
That's my homework this week. All I've done is marked up a beginnings of a sheet. This is just the beginning, and from this I'll untangle as we go through the week, I'll untangle my rule-based homework, if you like, to come back with next week.
But where do I buy? When do I buy, Gary? That's all I want to know. I don't want to do the work.
Well, I'll do the work.
Oh, great. I'll call you next week.
Okay. All right. Okay. This is really it's an example of where to start. That's all. So from
Gary, more than that.
Yep.
I'm 65 years old.
Mm-hmm.
I'm sure someone in the group listening is 25 years old.
Yes.
Or thereabouts.
Yes.
So their tolerance to risk and their acceptance of the grind
yes.
is different to mine.
Mm-hmm.
Yet everyone is looking for the same holy grail. And there is no holy grail. The only holy grail is within oneself.
Yep.
Work out what you want to achieve. Work out what you're prepared to sacrifice in that quest to achieve. And then swim like crazy. Like no one, I have 12 setups that I use that I've been using for the last 30 odd years. And they've been really kind. Will they be kind to you, Gary? I've got no idea.
Mm-hmm.
And it's the same with the people in the group.
That's right. Yep.
I don't purport to have the holy grail. I never purport to have the one road ahead. What I present on the one-on-one basis are a series of 12 different setups, various campaign management rules, and everyone comes up with their own individual RBT, as you are doing, Gary, with your own quest.
Yep. That's right.
Over.
Right. So that's exactly right. So all I've done here is an example of somewhere to start. That's my idea. Everyone can come up with their own idea around this, but it is the point is that it's sitting down with a pencil and paper and penciling out what you see and what you think you see in the market, and penciling out and building some statistics around that observation to see if it will be favourable to you or not. Because often we trade, and I've been as guilty as this as everyone. Often we trade on pure emotion, on momentum, that type of observation, or we trade on as we said at the beginning, on a tip sheet or something like that. And now we really want to step back and trade on how we build up a statistical base on how we see the market going forward.
So Gary, for example, right?
Yes.
One setup that I shared with you at the lowest low of the chart.
Yep.
Lowest low is both one setup being a gap open buy.
Yes.
There was also a RPW buy, which was first published by Edwards and McGee back in 1945.
Yep.
And what I've done is I've refined the movements that are needed for an RPW buy.
Mm-hmm.
You call it a horn buy. Well, yeah, a horn sounds cute.
Yep.
But what is really a horn, right?
Yep.
And I go, well, it goes from a valid spike low to a valid spike high to a valid spike low to a valid. It's all rule-based and black and white.
Yep.
Which means it can be incorporated into a rule-based or an algorithmic-based approach.
Yep. Yep. So,
which takes a lot of coding.
Yes. So in this for this first week, let me go back a couple of frames here. In this example of a promise bar, you could write down some basic guidelines here and say, well, I'm going to buy on the once the promise bar is identified as being longer than the previous bar, I'm going to buy on the close of that period and then take my profit or loss on the next bar. And you can write,
or you can go to a lower time frame, and I will take a buy setup in the same direction as a promise up, as long as it's not fulfilled.
Yep.
Or you can say, I'm going to sell the breakable high of a promise up bar on a setup.
Yep.
With a view that the promise is being fulfilled. So what I'm talking about, what I'm sharing with you personally, Gary, is the ability to create something from your own imagination and go, either it works or it doesn't.
Yep. Yep.
For the individual involved.
Okay, so first question here, really great question. And the question is, does it matter whether we use daily or weekly charts or some other time frame? So
yes, it does. Yes, it does. If you use a weekly time frame and then you follow the traditional approach of going to a daily, you have 5 days within a week. And those 5 days can go one way or another and just jump all over the shop. My approach is, if I'm using a time frame of a higher order, for example, a weekly, I want to look at a 2.5 day time frame.
Yep.
Which most people don't have the access to.
Yep.
So a 24-hour and a 12-hour time frame.
Yes.
Or a 48-hour and a 12-hour time frame.
Yes.
Or a daily and a 12-hour time frame.
Yep.
Circumvents the jumping and zigging and zagging between different time frames.
Yep.
Like 12 and 4 and 1 and 5 minutes. I haven't found a way that it works, which doesn't mean that it doesn't work.
Yep.
I just haven't found it. Over.
Yep. Okay. So with that, are there any other, now's a good time to ask some questions and we'll deal with them straight away. So before we just go and have a look at some...
Unmute them.
No, I've tried that. No, I've tried that before and it doesn't work. It simply doesn't work. I really have to take questions by text, and I will come to the... Okay, so the next question is, does a promise up bar require that the close above the open?
No, the promise bar is simply a larger range. The promise up bar is simply a larger range, number one. Number two, a higher high. Number three, a higher low. Shut the fuck up and move on.
Right. So the next, thank you. So the next question is, how much bigger is 1 pip enough?
What separates you from being alive and dead? 1 heartbeat or more than one?
Yep. So 1 pip is good.
Question.
That's it.
It's really black and white, Gary. I hear this question so often. What does it qualify?
Yep.
Well, 1 heartbeat, one snowflake causes an avalanche.
Yep.
And that's the hard part for people. People want confirmation. Am I on the right trip? Am I on the right boat? Am I in the right ship?
Yep.
Well, it's one or that makes the difference.
Right. Okay. So the inside your GoToMeeting little box that you've got on your screen, there's a little handout area there, and I have a thing called cheat sheet, FP Markets Homework. It's a PDF file outlining...
Or Gary?
Yes.
Next time you do that, spell it right.
Yeah.
Homework, not rock.
Oh yes, I saw that. I saw that when I uploaded it. Yep. I think it's my glasses or something. It must be my glasses. Yes, that's right.
In your hand or on your eyes?
Homework rocks. That's all it is. Okay, so the cheat sheet is there as a guideline to get you started on this. I'll certainly take any questions off you during the week. but we would like you to come back this time, before this time next week, with a completed 4 sheets of the beginnings of your rule-based observation of the market. Now, okay, I had a slide here and it's clearly gone. Don't you love technology? I will show you the yeah, I thought I had it here. I'll just have to do it here quickly. It's on the this is on the cheat sheet, but I'll put it in here. The homework goes to FX homework at fpmarkets.com.au. So
doesn't go to my email address. Thank you.
Yeah, it doesn't go to Ivan's email address. Comes to, and I will review it. Ivan and I will certainly look at it. We'll make that a bit bigger. There we go. This FX homework at fpmarkets.com.au, it's written on the cheat sheet for you anyway, and on the cheat sheet is just a couple of ideas that we've talked about and shown you along the way. And are there any other questions? Okay, we've got a few questions.
Great.
Yep, would be interested in which of Ivan's 12 setups offer the tightest stop losses.
They all offer the same stop losses because the stop loss is the pain threshold is dictated by your R value.
Yes.
So if the range of R is 100 points versus the range of R being 10 points, you adjust your position size, so your dollar value risk is the same.
Yes.
Next cue.
Next cue. Yes. So the time frame your research is based on would match the time frame you trade in. Absolutely.
The time frame you research will match your DNA of what you can do.
Yes.
For example, I have a guy who's trading crude oil on the basis of 20-minute and 10-minute time frames. So two time frames, 20-minute and 10-minute. That suits his geographic location, which may not suit yours. I have someone else who's trading a 48-hour and 12-hour time frame, which may or may not suit your time frame.
Yep.
Someone else trading an 8-hour, pulling in 300 hours for 2 years. Yep. So it gets back to the individual as to what suits the individual, not what works.
Yep. Okay. Next question: is the overall challenge is the overall challenge to identify entry points and ascertain the, I'm not sure, PR of increase or decline after that entry point?
The overall challenge is lifestyle matched against risk.
Yeah.
If an approach that produces 1,000% a year is something you can't attend to every 5 minutes or 1 minute or 30 minutes or 2 hours, what does it matter? The RBT and the DNA of the RBT needs to match your own personal DNA. If there's a mismatch, it will not work for you.
Yep.
That's 101.
Yep. Where can you get candlestick charts in different time frames? There's your first piece. There's your first piece of homework. You should know by.
But seriously, Metastock, Supercharts, TradeStation, IC Markets, you name it, they all produce MP4. Even MP4 produces candlestick charts on different time frames.
Yep.
Not
Iris.
all variable. Yeah.
Iris.
They're all there.
Yep. Yeah, there are many programs will produce candlestick charts in different time frames. But it's a great question because it brings up the point, something that I'll get a bit personal here. Something that Ivan hits me over the back of the ear with on a regular basis is that if you
Size
need
12.
size 12s, if you need to know something, go and find out. Don't
Pulling your
ask,
finger out.
don't ask the question, just go and find out. And as they say, Google is your best friend.
Google your friend.
Yep, thank you. Okay, so everyone's got the cheat sheet. So what about volume, or is this exercise aimed at concentrating on price alone?
Okay, your name is George and surname Soros?
Yeah.
What the fuck does volume have to do with someone living in Australia trading a small personal account?
Yeah.
Straight question.
Yeah.
These questions are just banal to me, right?
Yep.
They're for the sake of saying, hey, I'll listen and I have a question.
Yep.
My question back to the person who asked the question right in their face is, what are the position limits on the market you want to trade? What's the position limit on gold futures? What's the position limit on US Treasury bond futures? What's the position limit on soybean futures? You come up with an answer, I'll happy to talk with you for 2 or 3 hours, gratis.
Yep.
But to ask that question, I go, next.
Okay. In your experience, does the spread define the lower time frame resolution of a pivot point technique? In your experience, does the spread define the lower time frame?
No, it doesn't. The spread defines the spread on any time frame.
Yep.
So the spread on a 1 hour chart would be the same as the spread on a 3 minute chart or a 1 minute chart.
Yep.
So it's the spread. And one of the challenges of someone doing a back application or a back test is to allow for the spread in their results.
Yep.
So if you're working with buying a breakout of a high, as a trader, you would need to account for the difference between the bid and the ask spread as a buyer.
Yep.
The ask will be higher than the bid. For your stop loss, you only need to account for the bid. Make sense, Sharon?
Yep. A question back on volume. It wasn't about how much depth there was in the market, but if volumes were increasing with the movement in price.
Volume in terms of reporting is another figment of imagination.
Yep.
The only 4 pieces of data that are real are open, high, low, close. Volume will always be estimated volume at the time, and then actual volume after the time.
Yep.
And I've seen those figures differ by a score of 10, 15%. So no, there's no volume accounting in what I do.
Yep. Yep. Okay.
Next.
Yep. And it's often a fact that when there's a book build going on, volumes don't get reported until the build is finished, which they aren't required to report until 3 days after the book is closed.
Same thing.
Yeah. Yeah.
Open, high, low, close is the only data that's real, and it's not even real, and it's workable.
Yep.
For example, on the Swissy US versus daily versus the Swissy US 12-hour, there's an aggressive ambush buy on right now.
Yep.
I can see the daily high-low, I can see the 12-hour high-low, and that's part of the lifestyle rule set. If it breaks the high, I'm happy to be long.
Yep.
What will I lose? I will lose 1 hour. 1 hour is X% of my account. That's my choice.
Yep. So that's just to come back. I've got some charts up on the screen now, but just to come back on to the content.
Great. Let's look at the charts on screen.
Yep.
Let's look at center chart.
Yep. Center. Top center. Yep.
And that's a That's a bar that has a lower low, lower high, smaller range than the bar before.
Yep.
So what is that saying? It's saying, I don't want to fucking go down.
Yep.
If the bar was saying, I really want to go down, it would have a larger range. Agree?
Yes. Yes. Yeah, that's correct.
And the bar before was a promise of lower lows.
Yeah. Yep.
Getting a larger range, lower low, lower high. The black bar down close.
Yes, got that here. So that's the third bar
Great.
back.
Yep. So the second bar back says, I don't want to go down. So we go down to the lower time frame, and the bar that completes the high time frame is which bar, Gary?
On that area is this bar here.
It's the little hammer low, right?
Yeah, the little hammer low. Yep.
Yep.
5196.
That's the buy setup.
Yep.
That's the buy setup. And the market's given you a 1 or 2 hour return in the last 2 bars.
Yep.
Not rocket science.
Yep. So
it's also not predicting the outcome.
Yes.
Let's go back to the bar. Let's go back to the bar I spoke to you about before, live on screen. Top chart, same area. 1, 2, 3, 4, 5 bars before. Gorb cell.
1, 2, 3, 4, 5. Oh, here. Yep. Let's open this
and
out.
The bar that completed that.
Sorry, we'll just get this out here. There we go. I'll come back the other way. Sorry.
The fifth last bar
is up here. Yep.
Is a Gorb cell, right?
Yes.
Now highlight the bar and tell me the closing price.
That's this bar here. So the closing price
Correct.
is
Closing price is
522 or 228.
Right, and go to the low time frame on screen. And that's why you don't open up.
Yep. Is this bar here.
Great. And that setup is a retest variation cell in terms of methodology, right?
Yep.
Which you know about, other people don't.
Yep.
And then move the cursor to the right. Period 1, period 2, period 3. Hey. And there's 2 or 3 are to be had. Like, most people get hooked on being a trader, which means you have to trade. And a trader's mentality is, no, you have to make a profit. And that's the difference between a person who buys and sells tomatoes versus someone who buys and sells futures or FX. That's a 2-hour return in 6 hours. Isn't that enough for one day? Like, hello? Hello? And the response from the questioner was? Is?
No, that's all good. Are there any other questions? We'll keep going with the questions.
Like, I'm happy to do this live, Gary. You know me.
Yep.
Right?
Yep. No other questions there. Okay. Let me go just quickly back to. I guess everyone has the homework as well, which is good. Let me go back here. So the idea is, as we mentioned, the idea is to take understanding we have people of various, I guess, levels in the room, if you like, but the starting place is to print out four charts with 50 bars on a chart and start marking off some observations about the market, the higher highs and the higher lows, or the pivot points, as I've alluded to in this presentation, and start to build up an observation of the around that in the marketplace. So I mentioned also that the homework, we really would like, this is just a work in progress that I'm working on. I'll come back next week with some results on this, but this is essentially the beginnings of building an idea to see if there's an outcome from that idea. And then the homework, if you could scan, photograph, fax, I guess, it back to fxhomework@fpmarkets.com.au. I'll put, yeah, good on you. I'll just put my telephone number on here as well. I'll put myself in for that. The office phone number, this is my direct number. That's my direct number there. That's my direct number there if you'd like to, if you've got any real questions around this, but it's quite straightforward. 4 charts, 50 bars a chart, and have a look at building some an idea around that. Okay, so is it possible to get access to Ivan's book at some stage? Yes, it is. The book is available. I'll go there now.